Good afternoon, everybody, and welcome to our tax investigations webinar. Surprising how quickly these weeks pass. Just waiting for everyone to enrol before we start. Thank you for those who've joined us already. We're just, if you've joined us already, we're just waiting for more people to come into the room. I can just see people entering, and we have over 100 registered today, so that's a very good turnout. We're very looking forward to speaking to everybody this afternoon. Just give it a short while longer. Just give it another minute, and then I'll run through the protocol and how people can send in their questions. The team here are all ready to go. Let's hope the connection all stays live. Okay, I'll give a brief introduction to this afternoon. My name is Dave Jennings, and I'm an ex-Inspector of Taxes with HM Revenue and Customs. I spent some 20 years with the Revenue, investigating most types of businesses, individuals, high net worths, multinationals, and the like. The last 14 years, I have been helping clients with disclosures, voluntary disclosures, and assisting with tax investigations and any type of dispute work with the Revenue. So I've over 30 years experience, both sides of the fence, dealing with everything up to Court of Appeal alongside counsel, tax counsel, and including expert witness work in criminal and divorce cases. I'm also a chartered tax advisor, and I've been with Churchill Tax since the start of this year. We have two other speakers today, Sally Hutchings from Morrisons, who I will let introduce herself in a short while, and my colleague Philip Webb here at Churchill Tax Advisors. So those of us in the audience who already know us, Churchill Tax Advisors are one of the leading firms of tax specialists in the country, with a number of offices around the UK and Scotland. We provide bespoke tax advice and help people with investigations, disputes, forensic accounting, and also accountancy itself. We work alongside accountants and solicitors, providing as much or as little work as they required on a particular assignment. And equally, we take obviously clients direct if they do come to us. So today's discussion is going to be Sally talking about the loan charge, which is obviously a hot topic this month. And then, as a change to the usual monthly webinar that we've been running, Philip and I are opening up a tax surgery. So we will take questions from the audience on any tax topic, and we will do our best to answer those questions today. We already have some questions that some of our audience have sent us before this session, and we will cover as many of those as we can as well. So without further ado, if I can hand over to Sally, please.
Hello everyone, my name's Sally Hutchings and I'm a legal director at Morrisons Solicitors. I was a solicitor with Customs and Excise for over 13 years, and so I spent my career specialising in tax litigation of all sorts, but predominantly indirect and tax. Today I'm going to discuss the loan charge, which, as we all know, there is a looming deadline of the 30th of September of this year, by which time, if taxpayers haven't settled with HMRC, they will be obliged, as long as they fulfil certain criteria, to declare any outstanding loans to HMRC. Now, if we look at this, the loan charge applies to outstanding loans made on or after the 9th of December 2010. Now, outstanding loans, HMRC view those as any loans that have not been repaid properly. And HMRC view repayment as being the full repaying in cash of the amount of the loan you received. They do not consider, as certain taxpayers have done, a circularity of movement whereby a taxpayer pays the money to the trust and then that money comes back. HMRC's view, rightly or wrongly, is that that is not a repayment of a loan. They also do not consider if a taxpayer has entered into another scheme which purports to repay that loan. It's HMRC's view that that does not enable a taxpayer to step outside of the loan charge legislation. It's also worth saying that the loan charge does not apply to outstanding loans made in any tax years before the 6th of April 2016, where there was a reasonable disclosure of the tax avoidance scheme and HMRC has no open inquiries. So reasonable disclosure, HMRC consider that reasonable disclosure amounts to a taxpayer having given them sufficient information on their tax return to enable HMRC to know the value of the loan, who the loan was made from, was it an offshore trust, was it a UK company. If those haven't been done, HMRC consider that those loans again fall within the loan charge legislation. So providing we're looking at loans after the 9th of December 2010 and they haven't been repaid and the taxpayer didn't provide HMRC with that level of information, HMRC expects taxpayers to declare the loan charge to them by the 30th of September and to pay the tax on those figures. Now, they're not expecting people to pay it back in one lump sum. Taxpayers have got certain options. So they want you to amend your 18-19 tax year to put the loan charge onto that return. They are then saying that if you can't pay the tax that is due for that particular return, that they will allow you time to pay much as the same way as they are in settlement offers. But you need to contact them, whether by email or telephone, and get that agreement in place. They're also offering taxpayers the ability to elect to spread the loan charge over 3 tax periods, so that you can divide it equally into 3 and declare it on your 18-19, 19-20 and 20-21 tax returns. Now, this might be a very positive and good idea for certain taxpayers who they should speak to their accountants and tax advisors, because whilst it will bring into account the self-assessment payment on account rules, so you will then be forced to start making payments on account, depending on the level of your loans, if you spread it over 3 years, it might not take you up into the higher tax bracket. And so it might be a tax effective way to do it. So, loan charge, you've got loans outstanding, you didn't disclose them. What if you're in the middle of a settlement agreement with HMRC, you're desperately trying to settle your remuneration tax use. HMRC are giving taxpayers until the 30th of September of this year, by which time, if you haven't managed to push your settlement through with HMRC, you will still have to disclose and pay the loan charge. Now, if people out there have got clients, or in fact you're a taxpayer yourself trying to get your settlement over the line with HMRC, I would suggest that this is the most advantageous state of affairs, because this draws a complete and utter line under matters. HMRC are allowing you up to 10 years to repay your loans. It covers all the taxes, so it covers the employers and employee national insurance, it covers your PAYE, it covers inheritance tax, which HMRC consider to be payable because of the use of a remuneration trust, and it also incorporates penalties. Now, HMRC's settlement terms at the moment vary. If you used a limited company for your RT, no penalties are due for your use of the remuneration trust. If, however, you are a self-employed individual using effectively the same trust, HMRC are requiring penalties to be paid. They're looking at between 19 and 20% on a settlement, but again, that can be spread over a 10-year repayment period. You can, and the HMRC aren't keen, but you can, if you're in the settlement process, say to HMRC, I'm happy to settle the tax and the interest element, but I don't believe I should be liable to a penalty. And you can seek to take that out of the settlement process and appeal that to the tribunal. You need to really consider your actions and the advice you took, or before you decide to split it out, because of course, when you go off to the tribunal, the HMRC can then levy a higher penalty with the hope that the tribunal will back them. And there has been a successful case that came out a couple of months ago in which the tax tribunal supported a 51% penalty, which is a huge amount of tax. And of course, this is a tribunal decision, so you haven't got the 10-year period in which to repay it. So some very careful thoughts needs to be borne in mind before you reach your decision on that. But if you are too late for a settlement period, because we've only got a couple of weeks left and the settlement terms have closed, so you needed to have registered previously, will paying your loan charge be the end of it? Well, HMRC is saying no. Apart from, as we've mentioned, there's still an inheritance tax liability. HMRC can still consider behavioural penalties. So what they are doing is they want taxpayers by the 30th of September to have registered for loan charge, amended their tax returns, and either paid the loan charge due or to have reached the time to pay agreement. After that, HMRC will then close up all other avenues. And this will be done via settlement terms that they're hoping to bring out by the 28th of October, which will scoop up the other areas. So as we've said, the inheritance tax, any behavioural penalties, any corporation tax implications this has on a company. And only when you've reached a settlement on those areas will you have then drawn a line underneath it. Now, I'm sure a lot of you are sitting out there and you've got clients who were very happy when they heard the 9th of December 2010 cutoff, because that enabled certain clients to think, that's brilliant, I'm free, I haven't got to declare a loan charge, it's all good. Well, HMRC are reconsidering this position, not in respect of loan charge, but their position is just because you don't fall within loan charge doesn't mean via the inquiry, their normal inquiry powers or their normal discovery powers, that they can't come after individual taxpayers and make assessments for the PAYE and NI. Now, if they're out of time, of course, one of the things they can do, and they are considering doing, is they try and go for a dishonesty penalty or a negligence penalty in order to extend their time limits to 20 years. So it is very important that we sit down with your advisor and look at all the different options, because HMRC are still allowing you to voluntarily pay tax on these sums, and by a voluntary restitution, this avoids HMRC, number one, having to take a very strong line on penalties, which is, say, we'll be looking at a 50% penalty. If you've voluntarily repaid or paid tax on monies, it stops them from charging interest. So that's something that's very important. Advisors, taxpayers, specialists shouldn't blindly look at the 9th of December 2010 date and think, I'm fine, I was before then. You need to look at the picture in a whole and just ask yourself, has HMRC got inquiries open in respect of the later years, because they are more likely than not then going to seek to recover the tax from years you might have thought were safe. So it's an important period, and it's very important that taxpayers and their advisors look at everything in the round. Now, there's also another an interesting area is everyone expects that the remuneration trusts were used to make loans to employees and directors instead of receiving, to avoid PAYE and NI. In fact, in not all times did that happen. I've got several cases where monies were paid into the remuneration trust by a company, and then the trust lent that money out to other companies. In those circumstances, and even though those other companies were directly linked to the director of the company that paid into the remuneration trust, in those circumstances, HMRC say if the director didn't receive a loan directly, they don't have to pay the loan charge. They don't have to amend their tax returns. In fact, what they need to do is sit and wait for the 28th of October, when HMRC are hoping to issue further settlement terms which will deal with these specific scenarios. Now, at the moment, HMRC are looking as to how that money should be taxed, whether it should be seen as a dividend tax, whether it should all be liable to corporation tax, and then if you've paid corporation tax on that money and then you've lent it out to other companies, then who is liable to pay tax on any interest received? So that's all up in the air at the moment, but it's important to have that in mind, because not all remuneration trusts were used to make loans directly to directors or employees. So it really is a case of looking very carefully at the rules, at the guidance, and if you're not sure, to write to, because most of these schemes at least have one inquiry open, to write to the officer who's in charge of your inquiry, and if you don't think you should be amending your returns and paying loan charge, to set out to that officer why you think that is the case. Because number one, it gives the officer, if you do it shortly, it gives the officer sufficient time to come back to you and say why they agree with you or why they think you're wrong, but it also protects you going forward on any behavioural penalties, because you haven't simply put your head in the sand and ignored the position. HMRC have got clear evidence that you were taking a course of action, the reasons you were taking that action, and whether it's right or wrong, as long as you've got a reasonable grounds for believing that you're not falling in with loan charge, these are my reasons, this is what I'm sitting back waiting to happen, I'm waiting for the October settlement terms, and it's providing you with a security against behavioural penalties, which, as we know, can be quite substantial. So those are the main things I wanted to run through with you, but it will be very interesting to see, as HMRC move forward, the settlement terms that were previously available weren't especially generous. Their main generosity was in the period of time they were allowing taxpayers to pay back up to 10 years, but they were forward calculating interest, so you were paying interest to be allowed to pay over a 10-year period. For companies, they were allowing them to deduct any fees they used for the scheme from their corporation tax, and whether they will allow those terms that they consider to be generous to continue, we await. But limited companies, again, were very differently treated to a self-employed individual who was expected to pay PAYE and NI on any fees he paid. So that individuals were paying, self-employed individuals were being forced to pay tax not only on the loans they received, but on the fees they paid out. So paying tax on money they'd never received, and they were being levied with penalties automatically. We might expect to see in any future settlement terms that HMRC try and get rid of those inequalities, because HMRC weren't happy with those themselves, that they felt that the harder stance should have applied to everyone, in that scheme fees weren't deductible for tax purposes and that penalties should apply. So it will be interesting to see what happens in October. No one knows yet, not even HMRC have agreed to their terms. But for those reasons, I would very strongly advise people, if you think you can get your settlement across the line before the 30th September, I would push hard, because that gives a client certainty, and certainly for a limited company gives quite an advantageous settlement terms at the moment. That's all I think I can say in this period of time, but if you've got any further questions, Churchill Tax are very well qualified and be more than happy to answer them. Again, they can forward any questions to myself, more specific questions, because if we were to go into all the detail of loan charge, I fear we'd be here this time tomorrow evening. But no, it's been a pleasure speaking to everyone, and say I'm more than happy to answer questions, as are my friends and colleagues at Churchill Tax.
Excellent. Thank you very much, Sally. That was a very useful update and general guidance on the loan charge. I did mention, for those who were here at the very beginning, that we can take questions from the audience. The aim of today's webinar was to cover the topic that Sally's gone through about loan charge. Philip and myself are open to general questions. This is a bit of a tax surgery. We've had a number of questions already sent in to us by people who registered before this seminar, and we will go through as many of those questions as possible. Equally, anybody in the audience who've got a question for Sally, myself, or Philip, type those in the box on the screen where it says type your comment, and if you type in your question there and press send, we will see those questions, and again we will go through as many of those questions as we possibly can. Was there anything else you wanted to cover, Sally, or shall we move into our general Q&A? I'm
looking forward to the general Q&A.
Excellent, thank you. I introduced myself at the beginning, so now I'll let Philip introduce himself, and then we'll move into the questions. And I think Philip can answer the first question as well, which I will read out for you, Philip. Thank you.
Thank you. Yes, I was with HMRC for 17 years. I worked as a VA. Well, I was actually started working for Customs and Excise, where I was a VAT investigator. I did that on and off for 13 years, and then spent the last 4 years working in the solicitor's office, where Sally was my boss. And I was trained as an advocate. So effectively, I was trained as a lawyer on the cheap, had a huge caseload, and would take the cases of fact to the tribunal and represent HMRC on the less complicated matters. I left in 2007 and have been working at various boutique tax firms since then, and have had quite a lot of Kittel experience. Kittel being the decisions that HMRC issue where they think you're not doing proper due diligence. And I've been with Churchill Tax since April 2019.
Excellent, thank you. Right, we've got some questions coming in. First one, what are the penalties that HMRC can issue against me if there is something wrong with my VAT or tax? What are the penalties?
Well, effectively, the penalties fall into two tranches. They're either inaccuracy penalties or wrongdoing penalties. I won't go through all the penalties now. We want to get through as many questions as possible. But in the inaccuracy penalties, you're looking at a lack of reasonable care, any deliberate errors or deliberate and concealed errors. The penalties go from 100% of potential lost revenue down to about 20%. A lot of that and the reductions and the mitigation that can be got for penalties, this can be available in the quality of the cooperation that you give HMRC. So, for instance, you could have unprompted disclosures is something where there's an error, you've discovered it, and you think, right, I better go to them because it's giving me sleepless nights. So you make the unprompted disclosure, you assist HMRC in quantifying and showing how the error arose. You give full access to your records. And in the case of VAT, some careless errors could be suspended on the condition that certain improvements are made, such as your record keeping. Unfortunately, the amount of the reduction in penalties will always be at the discretion of HMRC, but it is important that firms like us will sit down and point out to the officers what has actually happened. And in the case of VAT penalties, if we can get them suspended and you are set up to change your behaviour, then that really is a good result. The wrongdoing penalties arise where HMRC think that they've found an error, and these penalties can arise, again, go from 100% down to about 20%. This is an issue that we will be doing more of in a later webinar about penalties for income tax and VAT. So if this is something that you are especially interested in, you can contact us individually, or you can wait for the webinar where we deal with this issue. Okay.
Excellent, thank you, Phil. I think there's just one other point about penalties. If it's offshore, then there is a risk that some years now can get penalties up to 200%, depending on which country category something falls in as well. And with change of rules in 2018, so although the standard maximum penalty is 100%, if it involves something offshore that's not been disclosed, there's been a failure to disclose and failure to correct an offshore issue, then there can be a potential penalty up to 200%, which is extremely draconian and not a massive incentive to come forward, other than if you do come forward first, you might be able to get 100% penalty instead of 200%. So there is still an incentive, even if it's not an expensive one as well. But again, our advice is always better to come forward than to wait for the brown envelope, or even worse, the kick at the door. Nobody wants that. Certainly seek advice from ourselves or your accountant if you think there's something to disclose. We've got a question for you, Sally, if that's okay, if I can ask this question, and that's come in, and it's said about the extended time to pay instalment arrangements that the Revenue are offering for loan charge disguised remuneration taxpayers. Depending on their income levels, there is various bands which can be up to 7 years have been publicised. Someone's asked about is the 10-year time available for people as well?
Yes, I've certainly had success in gaining 10 years for clients. HMRC are taking very much a reasonable stance on this. Their guidance has said that they won't be looking to take people's family homes off them, so I think they're realising they've got to be sensible. So if you're looking for that, I put forward a lump sum if possible, and then explain the monthly sum that we're offering and why we consider that's a proper amount to do. HMRC don't want people overstretching themselves because they don't want to have to go back and having to renegotiate and sort out messes that people have got themselves into.
Yes.
And then just finally, I've also, because of COVID-19, had HMRC officers agree to time to pay agreements where nothing is paid for 6 months while people work out what their business is going to be capable of. And as long as you and then you contact them again in 6 months to say, like, this is my turnover now, so this is sort of what I think is an affordable and sensible sum.
Yes, I mean that's equally been our experience, that the revenue are reasonable if obviously you're reasonable with the revenue too. They won't be looking to force the issue if there's the way out of it. But almost as if by magic, Sally, you did almost allude to the next question. It's a good lead in, and that is, if I owe HMRC more money than I've got in cash and savings, can they force me to sell my house? Well, the quick answer is yes, they can. The longer answer is no. Obviously, they don't want to. They would rather find an arrangement to get payment, and certainly with loan charge and disguised remuneration, as Sally's mentioned, they have said they will not be looking to repossess or take anyone's property away from them in those circumstances. But that doesn't apply to every case of tax arrears. If somebody has a very large tax bill that's built up, and if it's been careless or deliberate, the revenue potentially be less sympathetic anyway. But if the only way that someone is going to be able to settle, ultimately, if someone can't agree an instalment arrangement with the revenue, they can take standard county court proceedings to recover liabilities. They can issue CCJs, they can petition for bankruptcy, they can wind companies up. If the revenue petition for bankruptcy for a debt, then it would be down to the official receiver or the insolvency practitioner who's appointed in bankruptcy to consider how they can recover those liabilities. And that may well be forcing someone to sell their home and downsize or go into make some other arrangements. If the property is owned jointly, then they can't force the sale. Obviously, you can't force the other joint tenant to sell up. What they will expect is the other joint tenants, tenants in common, whatever the contract is with the property being held, they will expect that other person to try and buy them out and make an offer. And that payment, that offer, can then be used towards paying HMRC, but obviously staying in the property. If it's not in your name as the debtor, then obviously you're not going to be connected and they can't force that. What I would say to the person who asked that question, obviously we can help with tax liabilities and make sure they are what the revenue are saying they are. Sometimes they may be estimated, and even if it's got as far as petitions or winding up or the court, bankruptcy court, we may still be able to reopen the situation and look at it afresh, even if appeals haven't been made. We might be able to make late appeals. It's always worth an attempt to check the liability rather than entering into any insolvency or any time to pay arrangement if the liability is still not completely clear cut and finalised. Beyond that, if you are in an insolvency situation, I would certainly recommend speaking to an insolvency practitioner and getting advice from the relevant specialist. And if you don't know somebody, we know a few that we can give names to. So yes, obviously in the most serious of cases, houses are at risk, as are general assets that someone might hold, but mostly the revenue try to avoid that as much as possible. Another question for Phil. Can HMRC issue a penalty against me if I'm the director of the company that's got into trouble? I think they're asking, can they issue can the revenue switch a penalty to them personally in their own name if it's their company that normally has the penalty?
The short answer is yes. The Finance Act 2020 has given HMRC quite draconian powers. They can do it if there is a substantial tax debt that's owed and the company becomes insolvent. They can also do it if they think that the company is likely to become insolvent. So if they think that moves have been made to talk to an insolvency, even talking to an insolvency practitioner, if HMRC get wind, then that can allow them to issue the penalty. They can also, and this we are seeing, and this is quite a relevant subject, is that I mentioned right at the beginning about the cartel work. In the instances where people are getting into trouble or having difficulties with HMRC over supply chain fraud, HMRC are issuing their cartel decisions. Sometimes they're assessments, sometimes they are removing somebody's right to hold a VAT number. They are then personally making somebody liable for the penalties that a company would have had to have paid, especially if the company again has become insolvent. HMRC are becoming very aggressive in this situation, and it has a further knock-on effect in that HMRC will then say, well, we are going to report you to the insolvency service. We think that your behavior is such that you've shouldn't be a director anymore. Now, what I would say is, and I have several cases where this applies, is that the insolvency service are actually quite understanding and also do want to know what the behavior is that is giving rise to these problems. And HMRC can at times, well, more than at times, usually be quite opaque in their reasons, just putting it on failed due diligence as their reason for doing it. In those situations, it is important to get ahead, to make an appeal if that's appropriate, if the penalty has been issued. Sometimes they will only ask, they will warn that a penalty might be issued and give you a chance to say why you have reasonable excuses as to why there shouldn't be a penalty. And again, working with the insolvency service rather than pushing against them, even though for a lot of people being disqualified as a director would be very difficult. And these are all some of the areas that are coming to light. And I think certainly with that old chestnut furlough fraud, where anybody may have committed furlough fraud, it's probably quite likely that the penalties will be applied personally, with all that goes with that. So again, if you know of anybody that's got that situation, you have a client who's run into problems, and I can say that you might think the client is perfectly on the level and is trading normally, and suddenly these supply chain, what are called supply chain cases, can come out of the air. There was a recent case in the High Court for a judicial review where a building company, and it was a proper building company, you could go on the website, you could see its projects, you could see that it was quite clearly using its supply chain to produce a sale and a considerable output, and yet they had had their VAT number taken away from them because certain of their suppliers had not paid the tax. So these sort of situations can come out of the blue, and they need to be responded to straight away.
That's very good advice, Philip. Thank you for that one. Not sure if this is a bit of a joke question. It might be a bit of a joke answer as well. How long is a tax investigation? How long does it last? Well, it's sort of, how long is a piece of string? Sometimes you've no idea. Well, one of my first cases that I represented when I first left the revenue had been already going for 20 years when I took it over from a colleague. That was outside the revenue, representing the client. I settled it within a few months, but that's quite extreme. Many cases can take a long time to go through the courts if it needs to go through that way. Some investigations can be settled in a matter of months. Very few are going to be settled in weeks, unless it's quite a simple answer to a single question. There may be a couple of areas where maybe investigations, for want of a better phrase, fishing as well, and in actual fact there is nothing wrong, nothing gone astray, and they maybe can close quite quickly. Otherwise, it does take time to settle an investigation. Inevitably, there's a toing and froing with HMRC, with information gathering, and then with looking to negotiate and settle something, or obviously looking to put the revenue's mind at rest that there was nothing actually untoward, nothing wrong, and that inevitably does take time.
Dave, can I just
sure.
add in here that tax investigations at the moment may be a little longer than normal because of COVID. Obviously, HMRC hibernated for a long time. Not all of them have woken up and stuck their head out from under the leaves. So that has had an unfortunate effect of stretching the length of time that HMRC are taking at the moment with responding to letters and telling you at what stage the cases are.
Okay, thank you, Philip. Another question here for Sally, if I may ask this one as well. If the deadline to respond to the revenue was the 5th of July, and that's been adhered to, and the information has gone into the revenue, but they haven't heard back yet from the revenue, there's been no proposal, and I know I'm aware of some other cases where we're still waiting for the revenue to come back to us as well. It's obviously getting quite close to that September deadline now. When do you think the revenue will reply, and will there be enough time to review it before it goes back? Do you know?
They won't reply unless you actively chase them. They are snowed under, and so it is a case of keeping on top of them, chasing them, trying to find a senior officer to chase. Once you get yourself to the top of their pile, they're very quick at getting back, and the figures are relatively easy to understand. But your concern is the 30th of September is a cut-off date after which they will not settle. So you need to be pushing them and saying, you've got your information in on time, it's not your fault, what do you need? Don't sit back, because you'll lose the opportunity to settle.
Yeah, so I think if the ball's in the revenues court and you've done everything possible and you've responded to everything, then it's up to them. If they've not settled before the end of September, we should still get the same terms afterwards, if it's entirely in the revenue's fault.
Unknown, I would doubt it, because once they bring out the new terms, those old terms don't exist, and their argument is we haven't got the power to push to allow you to have those terms. I would kick up a fuss now and just say, it's not our fault, we want the figures back. Come
get into them, ring them up every day, give them some grief.
No, absolutely.
Thank you, Sally. Another question for you. Can we reach a settlement with the revenue if we owe tax or VAT? Is it possible to ever reach a settlement when you owe them a duty?
It is possible with income tax, not so much with VAT, unless you can actually come up with a reason why the quantum of the VAT assessment is wrong. In that situation, it is possible you can reduce the amount of assessment. With income tax, I think there is more scope to reach a settlement. I think what you have to look at is you have to show that there is a logical and clear pathway to the settlement. What I must reiterate, though, and I thought of this when I saw the question come in this afternoon, not having the funds was never a cause for settlement, and HMRC will not entertain it. However, in the times we live in, it sometimes doesn't hurt to ask, as long as you're not offended by the response.
Yeah, no, good, good answer, Philip. Thank you. Next question for which I'll answer. What will the revenue need for a tax inquiry? Well, it's going to vary. Every case is different, so it will depend what the risks are that the revenue are trying to address. They only have to have a suspicion of something being wrong, a suspicion of fraud or a suspicion of an error, for them to ask questions. And quite often, they won't be definitive questions. They may be quite wide-ranging questions. So what information you will have to give will obviously depend on a case-by-case basis. But generally, they will need some documents or some answers which address the concerns and queries around either an entry on the tax return, or if something's been missed off the tax return, or if you're making a disclosure, they may want corroborating evidence to prove what you're saying. They may look at, if it's a full, what's known as a full investigation, a full books and records inquiry, they will want all statutory records and books of the business, or the individual, or the trade, the company. If you've got payroll, they may want payroll records as well, things like expenses and benefits. They may also want to see bank statements and cash reconciliations, etc. What they're not always entitled to is private bank accounts, unless the revenue can prove there's a link to the tax risk at stake. They can't just ask for private bank statements without a reason, nor should you give private bank statements without a challenge to the revenue, or the revenue proving their case why they're required. Otherwise, information powers that the revenue have can be formal, and they can issue a penalty if you don't comply. They can be appealed, although a request for statutory records are unappealable. That's another topic that we will cover in a future webinar around information powers. Thank you. Another question for Phil. Have the revenue got the power to search my premises?
They have, if they have a warrant. If they're just turning up and they haven't made an appointment, they have a power to inspect your premises, your business premises, which means that they can have a look round. If they're going into a takeaway, they can go behind the counter if they wanted to, though they can't hold up business or the economic activity. They should do it sensitively. If they say, what's in that cupboard, and you can say such and such, they can say, will you open it for me? And if you say no, then there is a chance that they will come back with a warrant. So you do need to be a bit careful. And what you're looking for if HMRC turn up is you're looking to be cooperative with them. They're, by and large, they're looking to see only if there is unpaid tax, certainly in places like where takeaways, etc., that are heavily using cash. And in those situations, cooperating with them, they do have the power to inspect, they do have the power to be on your premises, but they can't open that cupboard or that drawer unless they've got the warrant, because that would then become a search. If they see, I once had when I was working for the revenue, I was once on an unannounced visit where we didn't have a warrant, and one of my colleagues looked down and there was a lot of paper underneath the cushion. So he asked the owner of the business if he could pull the paper out, because it was in plain sight. It was he was allowed to do so, and when the gentleman produced it, that was all the Z readings that had been hidden and never declared. So that is what HMRC are looking for on those type of visits. I had another question which came in earlier, and it sort of goes to this. I deal in cash, and HMRC have visited and say I cannot do that anymore. Can they make me deal in electronic sales only? No, they can't. They can't compel you. What they can make you do, especially if you've got a till or an electronic point of sale, is they can make you, and they can request the records from you for those. But if you are a cash business, and as we know, despite COVID and the scanning of cards, there are still lots of businesses that rely on cash, and HMRC cannot compel you to use cash.
Thank you. You've answered two questions there, Philip. Thank you very much. Quick one for Sally. If about the loan charge, if I've already submitted my 18-19 tax return, but it didn't include loan charge, do I still have time to amend that return?
Yes, HMRC have given you till the 30th September to either submit a return or to amend a return, and they've said that there won't be any penalties for amending a return that's already in. So yes, you've got until the 30th of September to amend that return.
Right, grand, brilliant. Thank you for that one. Will you take over from my accountant is one of the questions, if they're looking for a specialist advisor. Well, obviously no. It's very important. Most of our work, in fact, comes from working with other advisors, accountants, solicitors, IFAs, even banks at times. Anybody who has a client, and particularly with accountants, we do not want to take clients from another accountant. We are there to add an extra service and to help with the particular issue that the client wants our advice on. And that can be as little as answering some questions or a letter, or it can be as much as dealing with the whole investigation. We can work alongside the accountant, or we can take over a particular investigation, but we won't become the new accountant. We will leave the accountancy advice, business advice, the compliance, everything that you would normally deal with. Your accountant will stay with your accountant. We will only provide as much or as little extra advice that you need, or the accountant needs for dealing with HMRC, either a voluntary settlement or an investigation. Probably got time maybe for one more question, Philip, I think, and that is, what happens if HMRC accuse me of fraud or deliberate behaviour, I suppose, but I've done nothing wrong?
Right, in that situation, if the COP9 comes through your door, then, and you are certain, and what I would suggest is that you really sort of look back over the last 20 years to make sure that everything that's been done, if there were any problems, if they weren't deliberate, then I think that you wouldn't be able to engage in the COP9 process. You wouldn't be able to sign the contract disclosure facility. However, I must add that some people, when they get the letter, even if they've done nothing wrong, would like and do try to say that yes, they have done something wrong, thinking that will keep HMRC at bay, and that's what HMRC want to hear. I cannot stress enough that that is not how the system is supposed to work. And if you signed a contract disclosure facility knowing you'd done nothing wrong but saying you had, then that could get you into as much trouble as anything else. If you have done nothing wrong and you are certain that you have done nothing wrong, then you must write back to HMRC and say, no, I am not accepting your offer. If that happens and you've done nothing wrong, they may or will carry out an investigation. In that situation, if they have misinterpreted information about you, which they thought suggested fraud, which is actually innocently explained, then that can be dealt with and you can still engage with them. And if necessary, if they pursue it and they raise assessments and penalties, then we would appeal on your behalf. and take this to the tribunal. That is what the tribunal is there for, and that is what we would do, and that would protect you, especially where HMRC have got the wrong end of the stick.
Excellent. Thank you, Philip. We do have time for one final question, I think, before we wrap up, and that is, my client has 5 buy-to-let flats which they've never declared. What should they do? Well, as we've probably covered already during these question answers, our advice is they need to declare it sooner rather than later. There is the Let Property campaign is still available. You do need to make sure you're making a full disclosure. You do need to ensure you're claiming everything you're entitled to reduce the tax to the legal amount that's required. You do need to self-assess the penalty and consider behaviours. And if, as Phil said about fraud, if in fact those 5 buy-to-lets are caught up with fraud, then it may be that the Let Property campaign is not sufficient disclosure. It all depends on degrees, facts, the value of those properties, how those properties were initially purchased, the funding of those properties, and the size of rents and what has happened over the years and how long this has been going on for. If it's very serious, I would advise that you need to consider, as Phil's mentioned, the Code of Practice 9, COP 9, which we've covered in a previous webinar, the Contractual Disclosure Facility. That gives you an immunity from tax prosecution, so you're not going to get a criminal record if you come forward, fully cooperate with the revenue, and reach a settlement. That is the best course of action for something that's the more serious case. If it's not as serious as that, then the Let Property campaign is available to make disclosures, and we are helping many clients at the moment through the Let Property campaign, and where we're getting cases closed and settled with agreement to the revenue. And as a couple of questions have been asked this afternoon, if people don't have the funds to settle in one go, you can reach time to pay arrangements. I think that covers the question. We need to wrap up now at the end of our time. A couple of very nice thank yous from people in the audience for some of the questions. They said some of the answers were really valuable, so we appreciate that very much. Thank you, and thank you everybody else for attending. You will get access to a video copy of this, and those who were unable to attend during this time will equally get a link to the video which they can watch at their leisure. It now just leads me to thank both Philip and Sally for joining us and speaking this afternoon, and please do contact any of us if you've got any further questions. Is there anything else either of you wanted to finish with?
No, just have a good evening, everybody.
Excellent, thank you. Yes, stay safe, everybody, and we'll see you next month. Thank you.
And
Bye-bye.